Welcome back to Crypto Meets AI. Gary here with an update for you. Do me a favor, friends. Smash that like button, hit subscribe, and comment down below. Now let's get into this. We're sitting at $2.52, trading with the range of 232 to 256. We're up about 5%. We're slowly starting to climb back up. I'm sure we'll continue to just gradually move back up into the 270, 280 range once again. And that's most likely where we'll start to see some resistance. If Ripple manages payments and liquidity through a Fed master account, it needs to keep XRP in permanent reserves to guarantee flows. That XRP is locked up as operational collateral, reducing circulating supply. Lower free supply equals greater upward pressure on the price. With Fed master reserves as operational collateral, it stops being a token and becomes infrastructure. Less supply equals higher value. That's the velocity equilibrium trigger. XRP turns into the monetary backbone of the new financial system. Just in, XRP has flipped Bitcoin and ETH in volume on Upbit. Bitcoin who? Ethereum what? The biggest exchange in South Korea is now being led by utility, not speculation. Utility is the next narrative. Ignore it, fade it, or ride it. Choose wisely. My followers already know what's coming. The ideal scenario is to replace government digital IDs with zero-knowledge proofs via a decentralized ledger. The blockchain that can actually achieve this will triumph worldwide. This is exactly what the XRPL identity stack is built for. XRP. DNA protocol turns zero-knowledge computation into an economy, and XDNA holders profit every time privacy happens. Each proof minted, verified, or anchored on XRPL consumes XDNA, transforming data protection into a network revenue. Here's why privacy is now economically self-reinforcing. Proof generation fees. Every ZK circuit execution consumes computational gas in XDNA, creating measurable token demand per identity verified. Verification demand. Off-chain verifiers trigger cryptographic proof validations, each requiring XDNA for ZK start computation cycles, anchoring on XRPL. Finalized proofs are hashed and attested on XRPL, incurring ledger-level settlement costs in XDNA, locking value into the network. Integrity checks and renewals. Recursive proof validation and lifecycle renewals reconsume XDNA, embedding perpetual economic motion into the protocol. Private requests. Zero-knowledge API calls by enterprises require XDNA for each privacy-preserving query, converting confidentiality into a continuous on-chain revenue. More proofs, more computation, more XDNA consumed. Privacy isn't just protected, it's monetized, my friends. It shouldn't be no surprise that after that manufactured manipulated crash, whales are scooping up XRP by the millions. 145 million XRP moved to Binance. 50 million XRP transferred between Bitfinex wallets. 50 million XRP shifted between unknown wallets. Not surprised at all, my friends. Not surprised at all. That recent crash was a brilliant opportunity, not a disaster. I generally don't understand why people are spreading fear. Do not let influencers mislead you into leverage trading or chasing quick wins. The real secret to wealth creation has always been simple. Pick solid utility projects, don't over-diversify, buy and hold. Trading looks exciting until it wipes you out. It's not worth it, my friends. I've made millions by holding the right assets, not by timing the market, but by trusting my conviction. And I continue to bet big on a few projects I believe will define the next era of finance. I would not recommend anyone trading with leverage or anything like that. Stay away from those exchanges. All they do is get you in trouble, in my opinion. They're nothing but gambling and casinos, basically. It's just like a damn casino. What really happened on 10/10/2025? Recap. Binance just reminded everyone who really runs this market. This crash wasn't about Trump, tariffs, or macro. That was noise. The real story happened inside the books. One market maker you definitely know moved 700 million to Binance hours before the crash. 200 million of that was in BTC. You noticed, then traditional markets bled. Crypto started to follow, but something was off. The order books on Binance went hollow. No bids, no walls, just a free fall waiting to happen. Volume on BTC candles, 2300, 2K sold. 0-100 hours, 12K. Even 1 minute candle had 1K BTC inside. Ask yourself, was this organic? At a liquidation pressure hit terminal velocity. Binance's own market maker stopped defending the price and pulled liquidity. This is exactly why Atom went to 0.001. And the worst part, traders couldn't even fight back. On every other exchange, you could close, hedge, or buy the dip manually. And that's not true. I wasn't able to do it on Bitfinex. On Binance, button stopped working. Stop orders froze, limit orders hung. Only liquidations were executed perfectly, but not in the way they should have been executed. Think about it. Your position 50x cross, stop at negative 1%. Market dumps 50%, your stop never hits. Your account gets nuked 25 times over. And if you're mirrored across pairs, it's game over. Arbitrage bots amplified it, selling where price still held, deepening the fall. Hitting protocols liquidated positions. Alts down 80%. Anything with 2x leverage or more was guaranteed gone. Some positions with even less leverage were liquidated. Hundreds of portfolios erased, some funds too. No one's admitting it publicly yet, but you can read it between the lines. The market just showed its real nature, unfair, manipulated, and merciless. Only the strongest survive here, and sometimes even they can't handle it. If you're still here bleeding but alive, you've already passed the test most never recover from. Don't quit now. Learn what actually moves price, not what influencers may or may not say. The next wave rewards those who survive this one. Like, share, subscribe, comment down below. We will fight together. In December of 2023, an anonymous user predicted Bitcoin would hit its cycle peak on October 6, 2025. The coin peaked at 126,270 on October 6. Since then, it's down 11%. If the pattern continues, the coin will set a bear market low 1 year from now, right on schedule with its 4-year cycle. Comment down below and you tell me, do you believe October 6th was Bitcoin's cycle peak or not? Now on to Chainlink. Oracles are essential for securing DeFi protocols during periods of extreme market volatility. That's why leading protocols like Aave use Chainlink, the only data and interoperability platform achieving key security credentials like ISO 27001 certification and SOAP 2 Type 1 attestation, providing projects with the highest reliability and security standards. Chainlink's industry standard Oracle platform powers nearly 70% of all DeFi markets and is designed to provide institutional-grade decentralized market data that is hyper-resilient in all market conditions. And that's why you can't compare XRP and Chainlink together, because Chainlink is a completely different system. It's a data-collecting oracle. Why banks are suddenly warming up to XRP and XLM. It's because of ISO 222 doesn't just add compliance, it makes crypto rails bank grade. Real-time settlements, 70% cost savings, Swift level integration. This isn't alignment, this is a takeover. Bullish points on how ISO 222 metadata makes XRP and XLM rails more bank-friendly. Enhanced data richness and transparency. Seamless interoperability with traditional systems. Cost and efficiency gains. Regulatory and institutional appeal, and financial inclusion and scalability. If you think the events of the last 48 hours were coincidental, think again. The crypto sell-off started moments after U.S. markets closed, on a Friday at a time when Asia and Europe are asleep. The oracles mysteriously all misfired prices that caused liquidation cascade. The market maker systems glitched and were creating inefficient liquidity. The large exchanges had user access issues. Users couldn't buy the dip. The data sites like CoinGlass and others were mysteriously hacked at the same time, so users had no data. This was a highly coordinated and well-executed attack. And finally, the UK scraps the 4-year crypto ban. The UK has lifted its 4-year ban on exchange-traded notes, reopening access for retail investors. And last up, what you should learn from this crash. Don't use leverage, don't use margin, don't use debt, don't pair trade. And altogether, just stop trading. The only way to make it is to buy, hold, and wait to get rich. Well, that's what I have for you folks. Until next time, stay savvy, stay stacking, and I'll catch you in the next one. If you enjoyed this, smash that like button, hit subscribe, and comment down below. And if you want more crypto deep dives, check out our videos right here on Crypto Meets AI. Thank you for watching. Remember to always do your own research. This is not financial advice.